Good day, everyone. The webinar will start shortly. Good morning and good afternoon. The webinar will start in a few minutes. Good morning, good afternoon. The webinar will start shortly. Good morning, good afternoon. The webinar will start shortly. Good morning, good afternoon. The webinar will start in a minute. Good morning, good afternoon, and good evening, ladies and gentlemen. Welcome to this live event, broadcasted from the Netherlands. We have participants from around Europe and beyond, so enjoy your afternoon tea or your evening snack while we get this started. Today you will learn more about the strategic angle, tax, VAT, and customs solutions in relation to Brexit. Because Brexit is coming, 4 months and counting. We have 4 speakers today, and even 5 if we count in our moderator for today, Remco Buurman, CEO of the Holland International Distribution Council. Remco will introduce the agenda and the other speakers and will moderate today's event. Remco, the floor is yours.
Thank you very much and welcome everyone. We have more than 200 registrations for our webinar this afternoon, and I hope and I think it will be very interesting. We are hardly recovering from the COVID-19 pandemic. Everything is getting a little bit back to normal, and the logistics industry has done extremely well. But the next challenge is waiting, and that is the Brexit. End of this year, then the new relationship between the UK and the EU has to take place. So we decided to have a series of 3 webinars about the Brexit. Today we have the first one, and this first one will focus on the history, the strategic outlook for companies, and then more in detail about the VAT and customs, and also the direct taxes. Next one will be in October. That one will focus more on the logistic implications of the Brexit. And then we have a third one somewhere end of November, beginning of December. And that one, well, we still have to decide what will be the final subject depending on how the negotiations will continue. And they are continuing. This week, only just this week, Boris Johnson put some question marks with the withdrawal agreement between the UK and the EU. All the presenters of today, they know everything about it and they will tell you more details about it. We have 4 speakers. First one, Raymond Nicodem. He will talk about the strategic impact and what can be the strategic implications for companies. What do they have to take into account? Then we have 3 speakers of blue turtle tax. First we have Helmar Klink. Helmar will tell us something about the history and the economic outlook of the Brexit, and we will close with Sri Nguyen and Jessica Young. They will tell everything about the VAT and customs. Then we hope to have another 10 minutes for your questions. There is a Q&A box on the screen, so if you have any questions, please put them forward. Now I would like to give the floor to Raymond. Raymond, can you kick off about the strategic perspective of this Brexit? The floor is yours.
Thank you, Remco. Good morning, afternoon, and good night, everybody. Let's dive in right into the timeline. We have come from a situation with a lot of clouds, thunderstorms in terms of the discussions and the results. Right now, in the middle of the slide, you see the transition period. I don't want to elaborate too much on it because it's kind of a sort of a worthless time other than keeping everything that is as it was. But I want to be focusing on the new era, that is the period after January 1st of next year. The situation is very precarious. Boris Johnson, as you probably have read in the press, it's already putting bombs under the withdrawal agreement. So again, I don't want to elaborate too much on the transition period. It will end in a few months' time, and we better look at the new situation. In order to do that, we're probably going to pop up the next sheets. We're going to look at 3 major situations to have the UK basically trade on its own on its own matters. First of all, is the scenario, the likely scenario, so to speak, where we're heading to in terms of dealing with the UK and Europe, vice versa, and its status. Secondly, is the internal situation where the UK has still to deal with. And thirdly, it's the most important one, the WTO membership of the UK and what's all about. So I first want to get into the scenarios. If we look at the scenarios, we're coming from the top left position, where there is a lot of dependencies between the UK and Europe, vice versa, and there's a lot of equivalence, say, level playing field. Now, that's exactly the situation where the UK wants to depart from. They went out of the EU to stand on their own feet, to get entrepreneurial. So basically, they have to fall into the other three scenarios. Well, the other likely, but again, it creates a lot of dependencies, is the like glue to the to China or the US, which is going to be like presenting the UK with a lots of other stuff, more or less European-like. So that's not going to be very likely. What's also not very likely is that the UK is heading towards the top right scenario, which is right in the level playing field with the conformity and equivalence. So that leaves one scenario left, is the fully competitive, fully independent, and that's where the UK is heading for. All of the signals were there already in January of this year, and also the political declaration will head into that direction, the dealings with that. If we look at the internal situation, that's the bills that the UK has to transform into laws, into acts. That is because some of the laws are basically sourced with European policies, and European policies are in direct conflict of the UK constitutional law. So it has to be rewritten and basically put through the process to get into acts. Now, one of them they passed, one of the 6 critical bills, that's the Financial Act. But again, there's 5 left. They have to pass before they can trade on an independent basis, and basically they have to pass those 5 to get even a World Trade Organization membership. Now, those 5 are still a long way from being finished and being finalized. So the UK people of our audience today, you might go into to talk to your MP and getting to chase up the government and the parliament to get those things fixed. Thirdly, we're going to go to the World Trade Organization situation. Now, the UK currently is member through the European Union, and that will obviously change as per January 1st. In order to do that, the UK has to make entry of 5,000 products and services into the catalog in order to deal with the other countries. Now that's doable, but what's very tricky to look at is what they call the most favorable nation treatment, which is basically if you go and give benefits to country A, and all of the other countries which are member of the World Trade Organization will automatically receive those benefits as well. So in order to stand on their own feet as the UK and deal entrepreneurial wise, you have to really get into a situation where you have to be careful in what you give out in terms of benefits. Now, the major areas of impact of the Brexit, there are many, but the ones I've listed here are the most important ones. Those are going to be hit severely by lack of a foreign trade arrangement. It's very unlikely that there's going to be a foreign trade arrangement, and there is one. If there is one, by January 1st, it's going to be very, very thin. So all of those elements I've listed here are going to be hit severely, and it's very wise as a company, you look into those specific elements very, very carefully. Because if you prepare, the best you prepare for those, the best you can deal with the situation in the new era. For instance, if you have a hosting service in your cloud in the UK, or as a UK firm has a cloud based in Europe, the GDPR will go berserk. Some of the things are going to become suddenly illegal or not arranged. So you have to be really, my suggestion, you have to really be careful and dive into those elements I've listed. If we go to the next one, I've listed some operational and strategic tactical elements. Now, operational, and that's where most people look at, they deal with like shipments, stocking levels, and like keep the stocking levels up to get delivery on time, because we don't know how long this will take. But again, there are no solutions really to the upcoming new situation. Obviously, you have to look at your general terms and conditions. They will be hit severely, so they have to be revisited. But my strong recommendation is look at it at a strategic, tactical angle. You have to look at your company, at your own supply chain. You have to look at your company and also the company of the clients you're dealing with, you're providing services for. The better you have that in mind and in sight, the better you're structurally equipped to handle the situation in the new era. Also, the benefits of the changing situation, because now the licensing, for instance, of a lot of the products and services, and again, to bear in mind, the UK is a services industry. They're less exporting goods, and they're exporting a lot of services. Look at the London City with all its financial services. But again, the goods and to get into a make industry will be a huge benefit, a huge opportunity, which will be a big turn for the UK. But again, it will be an immediate benefit for Dutch and European companies to look at that situation and to change the whole playfield. So that's in a nutshell what we can address today. I know it's very short. I know it's much. But again, at the end of the presentation, after the interesting presentation of my colleagues, there is a question and answer you can address, and any questions to me or to my colleagues. So we'll be back. Just hang in and relax and enjoy your webinar. Thank you. Back to Remco.
Thank you very much, Raymond. A great overview. I think you mentioned many items where your business can be affected. And well, as you say, you can better be prepared. Just a few remarks. First of all the slides of the presentations, they will be made available after the webinar. And you can use the Q&A box in the bar to ask questions. I haven't seen any come up yet, but still time. So if you have any questions, we will address them if we still have time at the end of this webinar. We would like to continue with Helmar Klink. Helmar will give a little bit of history lessons here. How did we come so far? How did we come to the situation we are currently in? And secondly, what is the economic outlook of a Brexit? Helmar, the floor is yours.
Thank you, Remco, and good afternoon to everybody. Very nice to meet you here in this online meeting. So I'm an international tax advisor, and a little bit later on I'll say a few words on corporate income tax developments. But I also do macroeconomics, and I have an interest in history. So we thought actually taking a historic look at the story of Braintree and Brexit is always interesting because it helps you understand where we are today. And when you think about this, first of all, we're inclined to think this is a story about an island and a continent. But I'm of the view it is really not an island and a continent. It's really a story of two countries, of Great Britain and of France. And I'll give you a couple of examples later on. It's also a story of the currency, which was always extremely important for the Brits. Thinking back a little bit further, so in the early 20th century and certainly in the 19th century, the UK, of course, was the dominant economy in the world. London was the global center of commerce, and sterling was the reserve currency of the world. So that was always at the forefront for the English, and not at all that important for the French and the Germans. So if we think about the period of the 1950s, we must realize that the English and the Europeans, the continental Europeans, were in a very different position. The English had held their ground against the Nazis. They still had their pride, which precious few other countries could say, least of all France. Whereas on the continent, the war had been a complete disaster and a lot of reconstruction had to happen. So that was the focus of the early six of the Union. So Germany, France, Italy, and the Benelux countries. The UK's perspective was quite a different one. Now, it was also very clear in a global context that in order to have peace in Europe, Germany and France needed to be tied in a union, which was beneficial to both of them. And the Americans had a very big say. They were very present on the scene in those days. And they wanted a very strong Europe in order to stop the advance of communism. So the European founding fathers, and especially the Frenchmen, Jean Monnet and Robert Schuman, they developed a lot of the framework for the EEC. And they really saw an ever deeper economic union as a way to forge an ever deeper political union. And so they really wanted this idea of a federal Europe. And if you think about how the French approach political power, then you can understand it. And the quote in italics is, to me, very important to understand the French way of thinking. So let's read it. Centralize political power as much as possible, not because it provides a better or more efficient governance model, but because it increases the power of the centralized power on behalf of those controlling the center of the power. Now, I'm a Dutchman, and Dutch politicians clearly haven't understood this lesson, which explains why they're not very successful on the European front. But the French are masters of this game, and Northern European countries try to build more consensus. The English, being an empire themselves, they were keenly aware of how the French approaches and were on the lookout, so to say. So Stan, if you can switch to the next slide. Now, two very important things happened in the 50s. The formation of the European Coal and Steel Community, which was the predecessor of the EEC and later EU. And of course, then in 57, the Treaty of Rome was the formation of the EEC. In both cases, the UK was actually sitting at the table, but in both cases, they opted out. So it's maybe useful to, especially in the context now of Brexit, to think why did that happen? Why did they not participate? Well, with the coal and steel community, they had the leading industry. They were market leader. And it was a labor government at the time. For them, it was a vital industry, and they wanted to improve the working conditions of the people working in the mines and the factories. So they had no appetite of surrendering that to a European supranational institution. And it was a little bit the same in 57 with the formation of the EEC. UK still felt very much, or Great Britain still felt very much like a former empire, and yes, of course, the US was now the dominant economy. But for instance, militarily, the Royal Navy and the Royal Air Force were only second in size and power to the US. They were the third nuclear nation. Now, there were a couple of other important elements. So London's focus on financial sovereignty and, of course, wanting to restore the status of sterling. London also had an attitude that they had a much broader focus than just purely a group of 6 European countries. Their vision was of free trade with the global world. And then, of course, in particular, their very strong bond with the US and the Commonwealth countries, which actually created also legal impediments to for instance, accept an EEC common external tariff. So they were not a proponent of a further European integration, and really had no appetite in surrendering sovereignty to supranational institutions. If you're a world power, why would you forfeit your sovereignty and subordinate yourself to supranational European institutions with maybe French leadership? So let's go to the next slide. Now, this was very much what I just mentioned, the character in the 1950s, but it changed actually. And the first painful experience for the Brits was really the debacle at the Suez Crisis, where, bereft of their empire, the UK could no longer execute an effective foreign policy on its own. And slowly on, they started becoming aware that Europe was moving ahead and that England was falling, or the UK was falling behind. And so on the next bullet, the quote of Maudling to PM Macmillan is an interesting one, I find, because it's still true today. So the fact is, the French do not seem to want us in Europe at all. The community of the 6 has become a Paris-Bonn axis. Bonn, of course, was the capital of West Germany at the time, with Paris at the moment the dominating partner. That's very much the case today. The other 4 countries are really no more than satellites. That's probably also still true today. So we saw the UK economy stagnating, and why? Very much because of the external tariff that the EEC had put up. And as Dutch Nobel Prize winner economist Jan Tinbergen already proclaimed actually in the 1950s, the distance to your trading partners is the key factor. So even though the ties within the Commonwealth were very important, those countries were far away, and the European continent, of course, was close by. So that dictates who your major trading partners will be. So the UK became aware of it, and they were also put under pressure of the US to join the EU. But there was a certain Frenchman who really didn't like that idea. And then if we can switch to the next slide. And that Frenchman was, of course, General de Gaulle. And he was very much anti-British, I think we can say now. So each time that the English actually applied for membership, the French vetoed it. No Braintree there in 63, and the same in 67. De Gaulle also found that this was sort of a 5th colony, and he sort of would get the Americans at the table. But most of all, he felt that the English didn't have the right attitude for to support their agenda of working towards an ever closer union and probably even a federal Europe. So it's only after de Gaulle was ousted that in 73 that the UK could join the EC. The rest of the timeline, I think, is well known. So Stan, if you bring us to the next slide. So to me, the other important point is the currency question. And of course, London was always the financial center, but after the war, all the gold of Europe had ended up in the US financial system. So Europe basically had they couldn't implement a gold standard. So Bretton Woods conference resolved that with the dollar convertibility, and the dollar was now definitely the reserve currency of the world. Then in '69, there, for people who are interested in the history of the EU, so the Bar report and the Higgs summit but most of all the Werner report. The Werner report, Werner was a Luxembourg commissioner. He basically defined everything that you see happening now. And there was a discussion of EMU, fixed exchange rates, the fundamental freedoms, etc. And already in '69, in The Hague, they already decided on this monetary union. So when the UK joined, they had to accept this acquis communautaire, which basically meant that you can't change everything that we've decided in the past, and you just take it the way it is, which wasn't really what the English liked. So we then see the end of gold convertibility, and then can you go back one slide, Stan? Yeah, so what we see then in the next two bullets is the collapse of the Italian lira, losing 80% against the German mark, French franc losing 70%. So when this EMU discussion took place, the English were looking at this. Why would you put these countries in one common currency? They are extremely different, so that can never work. And so when they tried to keep the European currencies together in what was referred to as the ERM, they were supposed to support each other. And in 1992, Black Wednesday is when Soros broke the Bank of England, and all of London was partying because all the hedge funds, of course, had joined the same trade and made a lot of money at the expense of the English taxpayer. Now, in that same year, the Treaty of Maastricht was signed. So it's no surprise that the English did not want to join in the Euro project, and they were, of course, rightly so. So Stan, let's go to the next slide.
Can you keep this one short, Helmer, because otherwise we will be running out of time. Thank you.
Yes. So very quickly on the economic points. So we've now seen global trade collapsing. OECD is predicting with 15%. That's of course extremely high. Debt to GDP ratios exploding. GDP contraction like not seen in the last 150 years. And it's synchronized all over the world, which to me says that we have deflation ahead. There's a certain risk of inflation, but to me, deflation is the bigger scenario. If you're interested, we could spend days discussing this, and I'd love to do that with you. But in the interest of time, I'll hand it back to Remco.
Thank you very much, Helmar. I think a great overview about what happened in the past. We continue with our next speakers, Sui Nguyen and Jessica Young, and they will tell everything about tax, VAT, and customs, and they will illustrate that with a couple of practical cases. The floor is yours.
Thank you, Remco. What a great stories from both Helmar als Raymond. 12 points for you. Doespa, 12 punten from us to you. I'm Sui. We will be doing this tax part together with Jessica and Helmar. Jessica and myself will do the indirect tax part. Helmar will have some comments on direct tax. We will take for our piece, the indirect tax piece, 3 cases, very simplified cases, and walk you through the impact for 1 January. I will have final note after Helmar's ended his direct tax part in the end. Let's begin. Jessica, to you.
Great, thanks, Sui. So we're going to start with a very simple case study so that we can talk through the basic customs and VAT principles for the audience. And in this case, we've got a UK manufacturer of glass, of jam, and they're sourcing glass jars to put this jam, which will then be sold to a EU customer. So on this slide, we're just describing what is happening now. As you know, currently in the UK is still in the customs union, so these movements of goods don't attract any customs formalities. And that it's dealt with as you do now. So Dewey, unless you have something to add, I think we'll move on to the future state.
Yeah, Jessica, I just wanted to say that under the current EU internal market for VAT, it's a lot simpler than we will have at 1 January, because we have a cross-border inter-EU system, which is only administrative, so no VAT cash flow currently.
Well, it's quite similar from a customs perspective as well, then, because right now there are no customs formalities. But if we think in a few months' time, from January next year, it's the most likely outcome is that there will be a border between the UK and the EU. So if we just take the jam example again, the glass jars will have to be exported from the EU now. From an operational perspective, for businesses need to think about who can act as exporter from the EU, and similarly, who will be acting as importer for these glass jars in the UK. There are some other considerations from a customs perspective as well. So when the goods cross a border, a customs declaration is lodged, and on this declaration there are a number of fields that the trader will have to fill in. So things like a classification for the product, a commodity code. So that's something businesses will have to prepare for before the goods start moving in January, and other fields such as valuation as well. So if you're a business that's currently moving goods with, say you have a branch in the UK and headquarters in the EU, that kind of transactions, if you have that kind of transactions, you should set time aside to look at customs valuation. So I guess the key message to take away from this slide is that, we've introduced a very simple case that's not necessarily a true reflection of reality, but still there are lots of things to do, to consider. So don't underestimate the time and resource required to prepare for the changes next year. Now over to you, Dwi, to talk about the VAT implications.
The VAT implications will be that we will, as you mentioned, Jessica, have a customs border between EU and the UK. This means that you will have to register everywhere if you are selling from the UK to the 27 EU countries. So there will be more reporting and more VAT formalities. Also, think about your current business and the VAT easements you apply. For example, simplified triangulation or call-off stock easements, you cannot apply them anymore per 1 January. And the last thing I would like to stress is that for non-EU businesses, certain facilities and easements are not possible. So also consider that, because you will compete with EU companies. So I think a good recommendation is to, instead of having VAT and customs formalities in 27 countries, just choose one single hub like the Netherlands, which is quite flexible on these kinds of matters. Thank you. Jessica, shall we go to the next slide?
Yep. Well, actually, before we go, because I see that someone's got a question about Ireland, I can quickly address that because it's actually on the slide. So someone asked if goods moving from the EU to Ireland, will there be customs formalities? Well, from, I say, Netherlands to Ireland, Republic of Ireland, because goods are moving within the customs territory, there won't be formalities. But if you're using the UK as a land bridge, then there may be customs considerations. So you may need to use transit or something like that. Okay, so we're in case 2. Now we've made it a bit more complex, which is closer to cases in real life. So here we've basically made the manufacturer an existing importer and exporter, which means they're familiar with the process of importing and exporting. And we've introduced a non-EU country. So assuming this is one that has a EU free trade agreement, then it means that the UK manufacturer can benefit from this free trade agreement, and they may be able to get raw material into the UK/EU at preferential rate rather than the most favored nation rate. So do you want to add anything before we go to the future state?
Yeah, I think in the current state, it's for EU, UK, we already discussed this. For EU, non-EU, it's the same as the situation we just discussed with the UK per 1 January. So you will have to face VAT VAT imports and registrations.
Great. So we'll go to the next slide then, because that's a complicated one where we have to cross more borders. So again, you know, we've kept the case, but now if we just look at it from a different perspective. So if the UK loses access to existing EU FTA with this non-EU country, then that would mean that when it sources raw material from that country, it may not be able to use a preferential rate. And that means its cost will go up. And similarly, when the finished product goes, what is sold to this non-EU country, because it will lose access to a free trade agreement, that product may not be as competitive. So essentially the message to our audience today is supply chains are complex, and there are things you may not have thought of before, like this origin aspect of supply chain. So it's really important to, you know, you don't know what you don't know, but so it's really key to, you know, understand, talk to others in the industry, and seek external help where you feel that you need to. And so don't underestimate the complexity of origin here. And if you have existing processes set up to import and export, think about how you're going to scale that up. If your EU trade is the majority and you only trade a little bit with non-EU countries, then think about whether your teams are ready to deal with an increase in number of import and export transactions. So over to you, Dwi, to talk about the VAT considerations.
Yeah, for VAT, I think the UK will become a non-EU country. So, as mentioned earlier, you will face import VAT, import registrations. Sometimes you need a fiscal representative. In some EU countries, for fiscal representative, you need a bank guarantee. My message would be, please try to simplify your VAT setup. Just choose one hub and for the EU, and operate from that hub, distribute from that hub. The other thing is with triangular situations is that I already mentioned earlier that the simplified triangulation, I know a lot of companies apply that in order not to register everywhere. That is not applicable anymore as of 1 January if UK is involved in one of those 3 parties. I think that for VAT, that's it. We will face a non-EU situation. Yeah. Okay. The third case is about e-commerce. We identified an issue for e-commerce parties who does fulfilling from the UK. So UK e-commerce companies. The 2 main events that will have implications are the Brexit we just talked about, and the new EU e-commerce rules for 1 July 21. Which are not applicable for the UK. The e-commerce, we're talking about business to consumer situations. For the Brexit, the implications are that there will be customs borders, so there will be duties due. on the other side, for VAT, there's an exemption for goods below 22 euros. So if you are selling from the UK to the Netherlands, for example, and the good is 20 euros, you don't pay import VAT, only duties, but for duties it's also below 150 euros, so you don't pay anything at all. The new e-commerce rules will be that the 22 euros exemption will disappear, so it's not applicable anymore. These two changes within a half year will have impact on your tax, your operations, your finance, your logistics, but also your commercial case. Let's take an example and see the impact from both sides. So this example is selling from the UK to the EU, for example, Netherlands. You see these three situations. First, the current situation. Second, the situation per 1 January. And third, the situation per 1 July. You see that per situation, the price of a product can fluctuate. So it would be very strange if you are selling on a web shop and your consumer who is buying regularly from you within a half year will face two different prices. The worst thing is that even if the price raises because of duty and VAT, your margin will decline because you will making costs for the logistics and the transport. Can we go to the next slide, please? Yeah, that's what I wanted to say. So for the EU to the UK, we only have one big event, and that is the Brexit. You also can see here that prices can fluctuate per type of good, regarding the value of the good. But the impact is less than the other side around UK, EU. Our recommendation would be just try to simplify your business. Choose a country in the EU, for example, the Netherlands, which has a good logistics system and has a flexible tax authority. Please go to the Netherlands and move your fulfillment here and distribute from here to the rest of the EU. That is the main message for this case. The next, I think we are quite done for our piece, Jessica. Helmer, up to you for the direct tax.
Thanks very much, Sri. And I think the comment that you made there at the end is the key message for the audience. If you're outside the EU, you do not want to trade with 27 different EU countries from a location outside the EU. That is highly ineffective. It means you will need to advance VAT, advance import duties immediately. So the obvious logical choice, and which is also what all US, Canadian, Japanese, Korean, etc. multinationals always have done, they've always chose a location in the EU, and from there on, they then start distributing their products through the entire internal market. Yeah, that is the experience and the best case to do. Now, Sri, you mentioned go to Netherlands. Now, of course, you can go to other countries as well. But what you will find is that custom authorities in the Netherlands are far more pragmatic. And pragmatic really in the Dutch sense. So there's no hanky-panky messing with rules. They enforce the rules, but they are pro-business and they understand business. So they will find a pragmatic solution. Sometimes you can have good technical discussions with them, but at least you find a solution. Sometimes in other European countries, Italy, Spain, France in particular, you can run into inspectors who really want to show all their own technical knowledge, and they give you a very hard time. So that won't happen in the Netherlands typically. Plus there are implementation rules on VAT that are more favorable than in other countries, and that can actually prevent that you have to forward cash already. So it's just also cash management benefit. Now, Stan, if you could take me to the first corporate income tax slide, because if we make the bold assumption that indeed you choose for the Netherlands as your hub into the EU, then you will have to think about Dutch corporate income tax consequences as well, which is my real activity more than history or macroeconomics. So right now, UK still being part of the EU, payments of dividends, interest, royalties are directed by the EU directives. That will change, of course, going forward. They will be governed by the double tax treaties. As a general rule, they will give not the same benefits. For instance, withholding tax on interest may go up to 10% instead of 0%, and same with dividends. In the Dutch UK treaty, it actually doesn't make that much of a difference. But if you, for instance, are a holding company in the UK and you have subsidiaries in Italy or Germany, if those subsidiaries pay dividends to the UK holding company, do it before December 31st, because then it will still be governed by the EU directive, the parent subsidiary directive. Thereafter, you have to rely on the treaty, and that gives you a higher withholding tax rate. And in the UK, you can't do anything with that withholding tax. So that will be a bottom line cost that is easy to save, but you should also probably consider restructuring if you are in a situation like that. Now, if you restructure, especially last 5 years, 10 years, under OECD guidance, the G20, but actually a much broader group of countries is on board as well, have made major steps in preventing aggressive tax planning. So you need to always monitor, what is your business rationale for doing something, and you need to keep a very close look at anti-abuse provisions that could apply. Now, when you move a certain business activity out of the UK and you move operations, assets, or goodwill, and you transfer that over to a new company in the Netherlands, then the UK Inland Revenue will probably say, well, we think actually that there's a hidden reserve, there's actually a capital gain that you need to recognize, and EU rules would also allow them to levy tax on that gain. At the same time, when you arrive in the Netherlands, you should not open your first books using the old book value in the UK books. No, you should actually use that same step up and make sure that you get a benefit in the Netherlands for that higher step up, on which you already pay tax in the UK. And the good thing in the Netherlands is we have a very open relationship with the tax authorities. People like Sui and I would speak on well, maybe not a daily basis, but certainly on a weekly basis to tax inspectors on a first name basis, and that makes it they trust us, and that makes it easy for us to explain the case of a particular client, and they will work typically with us, and you can get certainty on that in advance. Netherlands tax rates, there's the discussion because of COVID-19, financial crisis, etc. So for profits above 400,000, they were supposed to lower the tax rate, but next week we have budget day in the Netherlands. They're probably going to announce that they're not going to do that. On the other hand, they are moving that threshold from 250 to 400,000 probably, and below 400,000 you have a corporate income tax rate of 15%, which is pretty decent, I would say, in the European environment. So in the interest of time, because we want to give you guys time to ask questions, I don't want to spend time on this because it may not be relevant for other people. What I do like to do is make sort of a final comment. There's a lot of doom and gloom about Brexit, but the message that we like to give to you is let's be open-minded. You know, the laws are what they are, and countries like Japan, China, Korea, the US, etc., they've all traded very successfully with the EU on WTO terms for decades. And sometimes, you know, like Korea and Canada now, they have an FTA, but sometimes that FTA doesn't even bring that much benefit. So with all the doom and gloom about Brexit, there are also some very clear benefits for the UK and in Brexit. And having Stan, could you switch me back? There's also some clear benefits in having your own FTAs that are tailor-made for the UK. So yes, there are downsides too, but like I said, we simply have to accept the laws as they are.
Yeah.
Wherever you are, Brexit is very likely going to have an impact on your business decisions. From us, you can expect that we will help you minimize your tax compliance and your tax inefficiencies in this new world that we guarantee you. Sri, I hand back to you for a closing comment.
Can I have one last note? I would like to thank HIDC for their cooperation. Thank you very much for making this possible. I would like to thank the speakers. Really great team. Good working with you. And I want to thank the participants. If you have any questions, in the last slide, our contact details will be there, or you can go to our website. Thank you very much.
Thank you, Sui, and thanks to all the presenters again. We still have some time left for questions, so let's start with the questions and see how far we can come. First, we start with a very easy one. That's what I understood. Will there be a difference between current EU HS codes and UK global tariff codes? Jessica, can I give you?
Yep, I can take this one. So the harmonized system is harmonized to 6 digits, and in order to import you need 10 digits, which means the UK could deviate. So you can see the UK codes on the website now, but it's currently only produced to 8, and they're going to update it. So the quick answer is yes. But if you are importing and exporting food products, it may be a bit more complex. So the UK have said that they're removing Mersing code. So if you're bringing food products that contain sugar or flour, or I think milk content, you don't need to have the additional 3 codes called Mersing code. But if you're bringing goods, shipping goods from the UK to the EU, and the EU importer would have to classify these products. So not only just the 10, but also including the Mersing codes, and that could take some time.
Thank you very much. And maybe you can also take on the next questions. The goods are moved out to Ireland. You had already the announced new launch by Johnson. He's changing the situation regarding business or import with North Ireland.
So I'll just address the Northern Ireland first. So basically, from the UK perspective, they would like movement of goods from Northern Ireland to Great Britain to take place as they do now. But there will be some changes if you're moving goods from Great Britain to Northern Ireland. So now there's still discussion going on, and I think last month the government published something called Trader Support System, TSS. So what they intend to do is help traders who are importing goods into Northern Ireland with their customs declarations. So it's a way of saying, well, we didn't lie when we did our political campaign. There will not be any formalities because the government will do it for you. So that's kind of like a way around it. So watch this space if you're bringing goods from Great Britain to Northern Ireland. But if you're trading goods between Northern Ireland, or Northern Ireland and EU member states, they should continue as they do now. And Northern Ireland trade with rest of world should continue as they do now, but the UK have said that any future UK FTAs will also benefit Northern Ireland.
Thank you. and I think I stick to you and or Sui. We currently have the choice between setting up a UK branch or subsidiary. Does Brexit influence this choice in terms of duties, VAT, etc.? We are selling parts and service for tax systems in the UK from the Netherlands. Can you answer? Any of you answer that one?
Well, should I do the customer's perspective? So as I mentioned earlier, if it depends on how the flow of invoices and the flow of goods take place, because if you are setting up a branch and then the branch is buying from the headquarter in Netherlands, you have to look at customer's valuation. Now, the problem with the UK, as always, is that guidances are, when you ask the customs authorities, unlike in the Netherlands, here they will say, oh, it's going to be published in due course. So everything is very fluid. So I would say if you can delay your business decision until there's a bit more clarity, otherwise you set something up and then the guidance changed. For example, the valuation guidance, that's pretty outdated, and they've confirmed that they're changing, but we don't know when that will be changed.
Yeah, I think the first question is, what is the reason of setting up UK branch or subsidiary for selling parts? By knowing that, because you can do it without a branch or a subsidiary, so there's some business reason for you there. If we know that, we can better answer your question. For VAT, the UK has an easement on the import VAT, but if you register for VAT in the UK, you don't have to pay VAT at import. I think maybe Helmar, there are also like transfer pricing issues here.
Well, yeah, but that's a bit technical, because a branch is part of the same legal entity. So if you then sell out of the UK branch to a UK customer, really your price is whatever the Dutch BV purchased it for. So as a general rule, we would always say, so a branch or a company, there's no difference. But you do get different allocation issues. So partly TP, but for also allocation of expenses. If you operate via a branch instead of a subsidiary in the UK, it may be so that for Dutch corporate income tax purposes, the analysis is, and the tax authority will also enforce that if, for instance, interest expense that you think you can deduct in the Netherlands, suddenly you can no longer deduct in the Netherlands, because the tax authority will say, no, those are allocable to your new UK operation. So you lose the deduction, and maybe your UK operation doesn't make enough profit to shelter those interest expenses. And there could be differences in tax rates, etc. So it is a bit of a complex situation. So it's something that will be interesting to discuss if we have a little bit more information, but that is sort of in a nutshell the reply.
Thank you very much, Helmar. It seems that it will not be possible to answer all the questions today. What we will do, we will ask the presenters to prepare the answers on the questions you've asked, and we will publish the questions and the answers on our website, so all the participants can have a look. We still have time for the last one, and then I would like to ask Raymond, can you tell something about the REACH legislation and how it will affect the exports from the UK, the export of chemicals from the UK to mainland Europe? Raymond.
Switch by Michael. Yeah, REACH is for chemical products. Basically, there's nothing really decided. It was part of the withdrawal agreement, which obviously is going to end. But at least there is a minimal need of a EU representation if the product is manufactured in the UK. You need a EU representative on the EU mainland, somewhere else in Europe. And you have to do that before December 31st to keep your listing on the Article 95 registration. If you don't, you get kicked off that list. and then you have a problem. But at least you need the EU representative. But again, hopefully the legislation will be more clear from a European perspective beyond January 1st. The European Chemicals Agency runs a webinar on especially on REACH. Floated up. It's on November 12th at 11 o'clock. So you might, the one that asked a question might have a look at that webinar to get more specifics on that question.
Thank you very much, Raymond, and thank you to all the presenters for your contribution today. I would also like to thank the audience. I hope it has been useful and fruitful for you. If you have any additional questions, please let us know, and we will either connect you to the experts we have presenting today, although you see their direct contact details in right now, but you can also connect to HIDC. Thanks again, and I wish you all a good afternoon, a good evening, or a good night. Thank you very much.